Hi, and welcome to this second Forex webinar titled How to Trade on the Forex Yourself. Now, for those of you who haven't seen my first Forex webinar, a little introduction. My name is Jelle Peters. I'm the writer of Forex for Ambitious Beginners, which is available in the Amazon store, both in paperback and for the Kindle. I'm a writer for financial media, and I frequently give webinars and seminars about financial trading and Forex trading. By the way, many of you have already bought the book, so if you have any questions about it, simply go to forexforambitiousbeginners.com and I'll be happy to help. Okay, so in this webinar, we're going to look at some essential elements for becoming a successful Forex trader. In the first webinar, we looked at some really basic stuff about how the Forex works. But here we're going to look at basically how you work, how you should work when you're trading. So we're going to look at setting your goals, a little self-assessment, what it means to trade your plan, which currency pairs to trade, how to protect your trading capital, which is very important, and how to get to a good exit strategy. Now, the first thing you need to do when you set out to become a successful Forex trader is to set your goals. And for this, you have to be really realistic. There are some people, for instance, who come up to me and say, okay, I have $500, how long is it going to take me to turn that into $10,000? Well, that's just, even the question is not very realistic. Depending on how much capital you have and how much time you have to study on trading strategies and how much time you have to spend trading, you can make more or less money. These are basically parameters that define how far you can go as a trader. So you have to pay attention to those. Now, this next question is basically the most important question when you do self-assessment, namely, what kind of trader are you? Now, in the book, in Forex for Ambitious Beginners, I devote a whole chapter to questions about, who are you as a trader? What are your strengths? What are your weaknesses? So if you have the book, I urge you to take a serious look at that, because it can help you to define who you are as a trader, which can help you in turn to get to a better suited strategy, trading strategy, which then increases your chance of success. Now, a very known proverb in trading is that you have to trade your plan and plan your trade. This is easier said than done for most people. This is because many people get emotional while trading, so even though they plan their trade, they then not trade their plan. Now, this first part is, if you look at here the steps that I've written down here, is about planning the trade, which means that you're rational in advance about what you should do when you start trading. So first, for instance, you have to find a trading strategy that is right for you. Now, that depends on what kind of trader you are. So are you impulsive? Do you hate every loss, or do you love big wins? Then it's about how much time do you have, how much trading capital do you have, and so on and so forth. And that then directs you to a trading strategy that is right for you. There's nothing wrong with checking a couple of strategies out, obviously, because you have to find out what suits you best. But one thing is for sure, the better the fit between you and the trading strategy that you have, the higher the chance of success, because it increases the chance that you actually follow the system, that you actually follow your trading strategy, and that is very important. So you have a strategy, you formulate conditions for opening and closing positions, which is the setup. You regularly evaluate your trading strategy, and based on that, you regularly tweak your trading strategy. This is basically a trading system that is for which the hard part is not whether or not it is profitable. The hard part is whether or not you can follow the system. Because if you can follow the system, chances are that it is profitable. Take just a moment to let this sentence sink in, because this is very important, and if you ever make stupid mistakes as a trader, remember this sentence. If you're not trading your plan, you're trading your emotions. It's simple as that. Either you're trading your plan, you're following your system, you're being rational, or you're trading your emotions. The first part has a chance of success, actually a big chance of success. The second part has not, which is the reason why so many traders, especially in the Forex, fail. Yes, it is a very fast, dynamic, exciting, and potentially highly profitable market, but yes, it also tends to make people very emotional. So be sure you're not one of those people. Now, one of the things you can do as a beginning trader is to keep it simple, which is why I've written down here the KISS principle: keep it simple, stupid. When looking at which currency pairs to trade, many beginning traders go left and right. They go from the most exotic pairs to the most liquid pairs and back. This is obvious. Most of the times this is not the best way to go at it. When you start out as a trader, it's hard enough. You have to get to know the trading platform. We have our trading strategy. You have to find out if that works for you. You have to keep a log so you can evaluate your system, so you can tweak your system. If you also then make it very difficult for yourself to follow all these different pairs and maybe even commodities that you're also going to trade, you're making it just simply too hard for yourself for no reason. So my advice to you would be start out with just one or two pairs. That's it. Preferably liquid pairs, so the euro dollar, maybe the pound dollar, or the dollar yen. Simple liquid pairs that you can get to know. Now, obviously, if you don't have any money anymore, you can't trade anymore. This is why rule number one, if you're a trader, is to survive. You need to protect your trading capital. So a good rule of thumb, if you don't know anything yet, if you don't have any information about how successful your strategy is, rule number one would be never to risk more than 3% of your trading capital as a beginning trader. Yes, there are other professional traders saying, no, that's too much, it should be 2%, and then there are others saying, no, it can be 4 or 5%. It's all true. I just came up with a very simple 3% rule, meaning you will not risk too much and you will be fairly conservative, but it will also mean that you don't have to come up with a lot of money to do a little trading, because obviously if you can risk only 1% or 0.5% of your trading capital, you need a lot of bankroll to get started. So 3% if you don't know anything yet. Now, if you do know a little bit more about your trading strategy, if you know that it works, for instance, you can approach it a little differently. For that, the rule of thumb should be a single position should not be greater than 1/10 of the total percentage of winning trades. The example that I've written down is fairly easy. Suppose you produce 40% winners, which is very doable. Then your position size should not be greater than 4%, which is 1/10 of the total percentage of winning trades. Is this rule of thumb alone gonna ensure that you're never gonna go broke? No, obviously not. But it can help you at least to prevent you from doing really stupid things. If you follow this rule, if you as a beginning trader do not risk more than 3%, or as a trader with an already working strategy, not risk more than 1/10 of the total percentage of winning trades, you will set yourself up for survival at least. Now, a funny thing is that most people would say that an entry strategy is more important than the exit strategy, but it's actually the way around. Entry strategy is, for all intents and purposes, it's a guesstimate. Nobody knows which way the market goes. We have, you could say suspicions, or we have, thoughts about it, and we have indicators. We think, okay, it's going to go this way, probably. But no one knows for sure, of course. So an entry strategy is important, but it's not everything. An exit strategy, then again, on the other side, is much more important, because there you can either lose more money because you have a bad exit strategy or no exit strategy, and you can take in more profits because you have a good strategy for when to get out of the market when things are good. So this is very important. Now in this webinar I cannot go in too much, of course, which exit strategy is best for your specific trading strategy, but I can tell you these two things. If you're a beginning trader, always set a stop loss and always set a profit target. Don't let anyone tell you differently. Just before you open the trade, think about when you want to go out of the trade and put that in. Set, okay, when it goes beyond that, I want automatically out of the trade. And also set a profit target, so you don't take profits too soon and you don't let your losses run too deep. Just always do that. It will protect you from disaster. Okay, so next time we're going to look at some popular Forex trading strategies. So if you don't have one yet, this is a good webinar for you. We'll touch on the most important ones. So we're going to look at trend trading, very popular, very difficult as well, not to understand but to execute. We're going to look at range trading and breakout trading and fading the breakout, which is one of my favorites. We're going to look at scalping and some other stuff. So if you want to know more about good and popular Forex trading strategies, follow this next webinar and take advantage of it. Okay, so that's it for now. Again, if you have any questions about the book or this webinar, for that matter, simply go to forexformbusinessbeginners.com and I'll help you there. Okay, goodbye.